Hi, Michael Lapede here to talk to you a bit about the small business deduction in Canada. First of all, what is the small business deduction? Well, it is a special deduction that you get in a corporation. In a nutshell, it allows you to make up to $500,000 net, paying a lower income tax rate inside your corporation as a small business corporation. And at the end of the day, this is an important deduction, and it's the reason why most small businesses pay very low tax. In Alberta, for example, it's 11%. Most provinces are anywhere from 9 to 12% that you're paying. And this is for active income only. Let's be clear, this is not a deduction for passive income. Passive income where you have, investment or a stock or a piece of real estate earning you income. This is active income that you worked for, and that's what you get that small business deduction for, not passive income. Now, there is a new rule that passed a little while ago that passive income over $50,000 in that corporation or in an associated controlled corporation, so if you own one corporation, then you own a second corporation, or majority of that corporation, over 50%. If any of those corporations that are connected are earning over $50,000 in passive income in a year, it starts grinding down the $500,000 net small business deduction. As I said, you can make up to $500,000 net before you pay a higher tax rate. But if you have passive income over $50,000, it starts bringing that down. For more passive income you have, the more it brings back that small business deduction. So this is important in tax planning. If you have passive income and you're doing real estate or investing or shares or anything like that, that we plan to make sure you still get your small business deduction, because it is one of the most important deductions for a small business corporation. Now, another thing people ask, and this is where I'll wrap this up, is you can utilize multiple corporations to multiply that small business deduction. But it comes down to the association of those corporations, because if they have the same ownership group of greater than the control of 50%, then those corporations are considered connected, and it's $500,000 between them. But if you have separate ownership, for example, let's say a husband owns one corp and a wife owns the other corp, each corp then has their own $500,000. So it's very important in your tax planning that you know that you separate your ownership if you're looking to multiply that small business deduction. Now, this is a very complex topic, and I just gave you some simple tips. There's a lot more to it, but I hope I've given you enough understanding that you know the basics, and now you can ask some great questions. Post in the comments below. Reach out to us. We'd love to hear from you if you have questions. Thanks for being a part of our business tips.